decide to pull an item. Anyone on the committee want to pull? Anyone from the public? All right, looking for a motion.
Approval?
All right. I will second that. City Clerk?
Member Schwartz?
Yes.
Member Alternate Willis?
Yes.
Member Alternate Smyser? Mayor Lopez?
Yep.
And I vote yes. So the motion passes.
All right, moving on to item number 3, public comment. Do we have any members of the public, City Clerk?
No.
All right, seeing no one here in person, we will move on to item number 4, reports. And I will shift this over to city staff.
We have Dewey Chu of CIBC to make a presentation on the pension accounts, and he is joining us virtually today. Thankfully, we can do that, so I will turn it over to him.
Good afternoon, everyone. Thank you for your patience, and apologize for not being able to join in person today. Hopefully, I will be able to join next quarter. Before I go over the report, I don't see. Oh, it's popping. I'm sorry. Do I need to share the report on my screen, or would it show?
I'm working on it.
Okay, got it.
Okay. It's up now.
Okay. All right. Can we go to the next page, please? Next page. So this is for the end of the first quarter 2025 report. At the end of the quarter, this is the current allocation of the pension portfolio. There's about 6% in cash, 138,000. About 42% in fixed income or in bonds, roughly a little over $1 million, and 52% in equity, $1.28 million. The total value of the portfolio at the end of the first quarter was $2.479 million. Now this is, next page, please. So in the last quarter, there was no distribution from the pension portfolio. There was actually $200,000 addition at the beginning of the year, roughly in the second week of January. So we put that $200,000 to work, added to bonds and a little bit to equity over the last quarter. There's still about 5-6% in cash, as you can see. That was sitting in high yield money market. So this is the value change of the portfolio for the first quarter. Started out with $2.2 million at the end of last year, $200,000 addition. The income received in the portfolio was $32,000, and capital appreciation was roughly $28,000. Bringing the total of income and capital appreciation to $60,000. Balance at the end of the quarter, $2.4979 million. This is the value change since inception for the pension portfolio. We started managing the portfolio at the end of the third quarter of 2009, starting out with close to $11 million. Over those 15 years, a little over 15 years, 15 and a half years, $15 million have been withdrawn. Income roughly $2.5 million, and capital appreciation, $4.2 million. So net out, that's the current value of the pension account as of today, or end of the Q1. And this is the summary of the performance over the last quarter, year to date, the last 3 years, and annualized since inception. So year to date, at the end of the first quarter, the pension portfolio returned 2.65%, averaged the last 3 years 5.25%, and annualized since inception, so since 2009, 7.17%. Just want to remind everyone, this is the portfolio is being managed with a balanced approach, about 50% bonds and cash and 50% equity. The year to date, there was strong performance in bonds and in stock versus the overall market. For the first quarter, the S&P or U.S. stock market was down 4%, 4.5%. The bond fund or the stock fund in the pension portfolio was tilted more value, and for the first quarter it was actually up 3.5%. So with the average of bonds and the stock fund, the average performance year to date for the pension portfolio was very strong. So this page is the summaries of the holdings in the portfolio right now. If you look in the middle of the page, there's a Schwab Treasury obligation money fund. That's $100,000 sitting in high yield money market toward the end of the quarter. We took the opportunity this month with the volatility in stock and in bonds to put some cash to work. So that will show up at the review for the next quarter, but that's the target is to try to bring the pension portfolio to be in line with the 50-50 allocation that we set out to manage. This, I'm going to go over our firm financial outlook and just a quick look back of the past quarter. As I mentioned earlier, U.S. stock was down 4.3% for the year in the first quarter. International stock actually did very well, but for the pension portfolio, we agree we did not invest in any international stock. But if you look back at the trailing 5-year, U.S. stocks still handily outperform international stock. On the bond side, long-term Treasury did very well as rate went down earlier in the quarter. Rates kind of normalized this past month, but for the bonds, that shows in the performance of the bonds in the pension portfolio. One thing to note, though, is on the pension portfolio bonds, we invested in very shorter term type of bonds comparing to the long-term Treasury. So that's, comparing that to the performance, it's more of intermediate bonds and shorter term bonds. Next page, please. Yes. So our investment theme for going into this quarter, at the end of last quarter in Q1, we had U.S. stock had a drawdown and a kind of a correction toward the end of March. It was the start of the correction was the start of tariff when the White House put tariff on Canada and Mexico, and that started out with repricing of equity. Over the last month and a half, the recession risk has risen. Comparing the previous 2.5 years, 3 years, U.S. stock or U.S. economy has enjoyed very strong, robust growth. Going into this year, the expectation was, the economy continued to perform, and we would the stock market would perform as well. The announcement of tariff really put a change in pricing on U.S. stock, and that kind of snowballed into concern about U.S. recession and kind of changed the outlook for U.S. economy. It's normal in a way of, for the stock market, as valuation was quite high going into this year. So with the correction in stock, it took out some of the froth in the equity market, and valuation now is back to more of a normalized level. The concern is still there, and I'm sure you follow the news with the market reaction over the past 3 weeks. In April, there was a lot of uncertainty, and the uncertainty is not going to go away. But this is a kind of a manufacturer market because of the policy change in tariff, and that's really the concern. Is it's going to escalate into a global trade war, and it's going to escalate into a global recession. That's the concern of the market, but overall, this is a very solvable kind of crisis that was manufactured. So if there's an agreement on a trade deal, or if there's a de-escalation, like today with the Treasury Secretary mentioned, that could send the stock market up. And right now we're looking at soft data in terms of sentiment on the economy. It's looking really bad because the sentiment is consumer and producer are cutting back, not knowing what the tariff situation will be like. But once we have some clarity and more of a defined direction on policy in terms of tariffs, we can expect the market to get back on track. Some damage could be done to the economy, but it hasn't shown up in the hard data yet. So for the next few months, our goal is to look at the hard data to verify if the sentiment has turned into more of a cutback on spending at all. Overall, the market is still quite strong. So there's another kind of issue or positive catalyst that we're looking forward to is the Fed. The Fed started cutting interest rate at the end of last year. Toward the end of last year, the Fed has stopped cutting rate this year because of strong economic data earlier in the year and unclear inflation data coming from tariff. If there's more hard data showing signs of a slowing down in the economy, and tariff has marginal effect on inflation, definitely we can expect the Fed to start or resume rate cuts, and that would be a positive catalyst for the market. Next. I mentioned earlier about U.S. economy. Recession has kind of appears on a lot of the discussion. The concern is with the tariff and the slowdown in consumer and producer spending, that could cause U.S. Or lead the U.S. into a recession. Right now, the hard data hasn't shown that yet, but it's mostly it's sentiment, and sentiment is not very good. If we have a clear trade policy, and if we have a deal between U.S. and China, or U.S. and Europe, this could be reversed. And as I mentioned earlier, it's a solvable kind of situation. So for the U.S. economy right now, we have really strong employment data. It hasn't changed yet, but that's the concern, that it could cause unemployment to go up. And over the next few months, that's the important piece of data that we'll be looking at. I think this page is kind of important in terms of since November with the end of the election, the market was very excited with the new direction in terms of policy on tax cuts and deregulation for economic growth. The worry about tariff was less about it's a way to increase raising tax, but it's more about it was a negotiating tool. So far this year, it hasn't played out that way, and that's the question mark that the market is put in place on President Trump's economic plan. If it was a negotiating tool, it really putting a unnecessary strain on global economy and U.S. Stock market and the economy. But if it's a negotiating tool, how long is it gonna be with us? And that's the question mark that really not many of us really trying to or really have a clear answer for. Next page, please. I discussed about the Federal Reserve. Right now the Fed is on a watch and wait mode. They have to wait, and just like what I mentioned, we're looking for hard data. The Fed themselves is waiting for the hard data to come in as well. It's unclear how that's going to affect inflation data. On paper is actually going to affect inflation data quite significantly, but it's a short amount of time. And if there's a reversal of tariff and there's a trade deal in place, that could change the calculus quite significantly. So we're all in a wait and see mode and watch what the Fed will do. Likely in May, they're not going to do anything with rates. If we don't have signs of inflation picking up or signs of economic slowdown significantly. Likely it's going to be the second half of this year when we see the Fed will start resuming rate cuts again. I'm going to skip this page, it just overall. And U.S. equity, as I mentioned, it was a kind of a rough quarter for U.S. stock going into April. It's another sell-off in U.S. stock, but again, this is coming from a very strong year in 2024 and a strong year in 2023. A lot of the valuation went up toward the end of last year. With prices come down now, it's more reasonable, and stock markets actually looks healthy with after this correction in overall market. So the source of sell-off, if you just look at the total S&P for the last quarter, the S&P was down 4.3%, close to 5%. The biggest drawdown was in the largest 7 tech stock, Tesla, Nvidia, Alphabet, Amazon. These are the companies that perform significantly better than the market in 2023 and 2024. Valuation went up a lot. So if you just look at the overall market, the market was down, but these companies actually went down a lot more. So the rest of the market was actually on stable for the year and actually went up for the year. So that shows up in the performance of the pension portfolio on the equity side, as I mentioned before. We're not too much leveraged to the largest 7 tech stock in the market, but more on the value side of the market. And for the quarter, U.S. stock performed quite well versus the overall index. I'm going to skip this page. We don't have really international equity in the portfolio, and we don't have any private investment as well, so I'm going to skip this page. So just kind of summarize our view, we have a kind of an equal weight view on equity. It's not as expensive comparing to just the end of last year. U.S. stock now valuation is more reasonable. There are still a lot of uncertainty, but some of the uncertainty can be solved with clearer trade deals and clearer tariff policy. So that's what we're looking forward for the next quarter, and hopefully we'll have more better data to show and share with the board at the end of next quarter. And that's all I have for today's meeting. Any questions or concern that I can address?
Thank you for the presentation. Do we have any questions from members on the board? Any questions from members of the public? All right, bringing it back to the board for discussion. This is just an informational item, so there's no action required on our part, but any discussion from any of the board members?
I will say, surprisingly, I have been following this fairly closely, and we're seeing a similar thing in overall city investments. It's a little bit different a mix in the portfolio. We don't have any equities in the portfolio for the city, but I think the common word I hear across all of these presentations that I'm following is uncertainty. So I think we really just need to be patient and thoughtful in what we do and not overreact. It's easy to get caught up in the big swings, whether they're down or up, but we have good advisors both in the pension fund and on the city investment side, and I think we're waiting to see. Hopefully it will settle out a little bit, but there's a bit more bumpiness to come. But I appreciate hearing the perspective, particularly across both bonds and equities, so thank you.
And then I will say really briefly, I agree, and I thank you for giving that assurance of a perspective, and I think hearing from our advisor as well today helped put things into a bit better perspective for myself, particularly when we're thinking about various decisions we have to make right now on council and what the long-term impact could be. Though I think you hit the nail on the head, though, with the key word being concern. Certainly, we don't want to see a repeat of what happened in 2006, 2007, where there was a lot of reactionary responses. And so I think today's report gives us somewhat of a, I wouldn't say like the most hopeful outlook, but lets us know that there's no need to ring the alarm button just yet. Yeah, I don't know if anyone else has any additional comments or discussion. All right. Well, thank you very much. We will move on right along. We have no.
Thank you.
Yeah, thank you very much again. We have nothing
Great, thank
for.
you.
What was that? Oh. We have nothing else further on the agenda. For item number 5, do we have any announcements from any board members? All right. With that said, I will adjourn this meeting at 3:26. Our next meeting will be on July 22nd, 2025. Thank you.